Good morning and welcome back to the BRN Sunday podcast. I'm Jeff Snyder with the Broadcast Retirement Network. So glad you could join us. We've got another great show for you this week as members of the media, financial services, and academia, analyzing all the news in retirement markets, technology, personal finance, and so much more. So sit back, relax, and enjoy this episode of the BRN Sunday podcast. Well, let's kick things off with a look at the latest social media trends on the LinkedIn platform. And joining me now is the Senior Financial Services Editor for LinkedIn. He's also the author of This Week in Finance, which comes out every Friday. He'll tell us more about that, Mr. Devin Banerjee. Hey, Devin, how are you?
I'm doing great, Jeff. How are you?
I'm doing well. So This Week in Finance, that's your newsletter that you send out every week, and you and the team construct that, right?
That's right. The global team is curating and featuring, top news of the week every day, 24/7. And every Friday, we compile the top news in the finance and economics and investing industries and sectors into this newsletter. So you can subscribe from my profile. We've got about 90,000 subscribers getting it every Friday now, and
wow.
Growing pretty fast.
Absolutely. Well, it's awesome. I read it every week, and I know, Devin, a lot of what you talk about, and we talk about a lot of different things on this network and this program, come from what you guys are sourcing on a regular basis. I'm actually jealous not being a part of your team, but I feel like I'm a de facto team member in some ways for you. So what's top of mind this week for you and your team? Lots going on, E-Trade, lots of different things going on.
Yeah, definitely. The brokerage price war has driven a lot of M&A, and that's a nice preview for what we'll discuss on the network tomorrow morning. The first item I'll touch on, though, is some original research that we conducted in the finance space at the end of last year. And this was in response to a lot of the big institutions in financial services, you may have noticed, have started touting their family leave policies, especially parental leave after new children are born. And some of the biggest institutions like Goldman Sachs and Citigroup and others have really touted how they've made parental leave for new mothers and new fathers equitable. So for some of these companies, it doesn't matter if you're mother, father, or primary caregiver or secondary caregiver, as many companies still designate parents. Everyone gets access to the same amount and type of paid leave. And what we wanted to study is, the policies have changed on paper, but has the culture changed? And are men still encouraged or expected, to take as much leave as they're now offered? So we surveyed 1,016 U.S. financial professionals at the end of last year. And what we found is a really statistically significant gap between how women in finance perceive taking leave and men in finance perceive taking leave. So about 92% of women said they feel comfortable taking all of the paid parental leave available to them, and only about 70% of men said the same. And 2/3 of our male respondents kind of agreed, saying that the industry expects men to use less of the parental leave available to them than women. And so we fleshed this out with some reporting, some anecdotes, and I spoke with some kind of experts around parental leave policy and people, sociologists who study this issue. And they actually came up with these really great recommendations for companies and managers, 8 of them that I'll just touch on really quickly. So for companies that have changed their policies or want to change their policies, but really need to change the culture, a couple of recommendations. One, make sure you're kind of tying the case for people to take leave to profit, to the bottom line. And really the point there is that in today's labor market and generally, talent is really expensive to find and also to train. And a lot of companies invest money and time and resources into training employees, and you don't want to lose them because of a lack of good parental leave policy. Second, you want managers and leaders in the company to really walk the walk. You want them to be, demonstrating that leave is available, and you want to see them taking this leave as well to encourage their reports and others in the company to do it. This one I found really interesting, framing policies like this as instead of saying, you can opt in to taking your leave and it's an option, framing it as kind of an opt-out framework. So saying to new parents, hey, we have this policy. I assume you're going to take all of it. Let me know if you're not, instead of the opposite. Flexible arrangements are really important. So you see a lot of companies, instead of saying you can take 4 weeks or 6 weeks or 8 weeks right after your child is born, they're saying, hey, you can stretch this amount of leave out over the course of the first year of your child's life. That's really important, so that families at home can come up with their own arrangements. And then just different ways that you communicate the policy. So remind fathers that they're lucky if they have access to paid parental leave. Unfortunately, in the U.S., less than 20% of private sector men actually have access to paid parental leave. So when a company does have it, you definitely want to communicate that they're fortunate. And I'll skip ahead. You want to have father resource groups. You want to make sure that men feel comfortable connecting with others who have taken leave, learning from them, how they arranged it, how it felt, what their experience was. And then the last one I'll mention is just communicating it. I mean, the first step is ensuring that men know these policies exist. And you don't want to just put it in the employee onboarding process, that first day where you're thrown a bunch of information about your retirement plan and this and that. You want to continually communicate it, even putting up signs in the office or, digital signage on screens around the office. So a really important story. It's ignited kind of a firestorm. We have hundreds of people sharing their stories. I saw someone commenting on the story with like a 500-word, effectively, essay.
Wow.
So I would definitely encourage people to take a look. It's a really important conversation happening.
Any sense from the research as to why men wouldn't take is it like, I don't know. I mean, not to stereotype, but is it like, bravado or fear of losing a job, or I don't know. I'm just asking.
It's a great question. So in the data, we looked at some of those factors, and for men and women, there's some that are equal in terms of what drives their decision for leave, like desire to spend time with the child, obviously. But where you see men really weighing factors heavily is workload and deadlines. Company and team precedent, which of course, just means that the way things have been, perpetuate the way things are and continue to be, which is men, especially in finance, just have not taken much leave. And another interesting one was input from the spouse or partner. Men really weigh that quite heavily, which through our reporting, we kind of found to mean that men look to their partner, to their wife, for almost approval or kind of a nod to say, you know what, you can take this much leave and you don't need to take that much leave, kind of a thing. Whereas for women, it's considered almost a default. Input from the spouse partner is not so important because it's just the default that they will take their leave.
Yeah, I mean, it's a benefit. I think, look, there's definitely we all have, based on our experiences, right? So, obviously if a corporation comes up with this policy and wants to implement this policy, they do so knowing that people will use it, or they want people to use it, right? If you don't, I just guess I just don't understand why people wouldn't take a benefit. Like, it's like not taking your days off, right? I mean, kind of the same thing. It's like, why would a company give you a vacation time to not use? Like, I don't know.
Yeah, and actually there's a really important element in the conversation that unfolded that's coming from small business owners and operators and entrepreneurs, or people like who just operate themselves, like independent salespeople. And it's their perspective is really important because they're saying, I just cannot take that much, people who can decide how much leave they take and time off, but they're kind of grinding away on their own, and if they take 2, 3 months, 4 months off, there's no one paying their time, especially if they're a salesperson working on commission, et cetera. And we thought that was a really interesting perspective coming out in the comments. And a lot of people are engaging with those people in the comments really professionally, trying to come up with solutions and ways, looking for contract workers and stuff to help plug the gap. But it is true, to your point, that this is a story that's really relevant to people in big companies or just companies that have established policies. But we need to recognize there are a lot of people out there in the gig economy and just independent workers, contractors, et cetera, who just still don't have this option. And there isn't a federal paid option, of course. The U.S. is kind of last on the list among developed countries in that regard as well.
Yeah, well, good information to know. Thanks so much for sharing that with us, Devin. And we will catch you on the network, as you said, tomorrow. We don't we teased some of the stories, but you're not going to want to miss it. Devin Banerjee, always a pleasure chatting with you. We will talk with you first thing tomorrow morning.
Sounds good, Jeff. Take care.
Bye.
Yeah.
Welcome back. And now we're going to shift gears, talk a little technology. And joining us on the line, he is a senior technology and consumer products reporter with the Motley Fool, Daniel Klein. Hi, Dan. How are you?
Hey, Jeff, technology never ceases to amaze me. The fact that we're taping this and I'm in a hotel room using free Wi-Fi, I mean, it was just a few years ago where like that wouldn't have been all that viable or we wouldn't have been able to make a connection. So you're really seeing Wi-Fi and other technologies just become an almost default pretty much anywhere you are.
I know, and you know, we always joke about the fax machine and how that transformed business. I got to tell you, I am so, as you know, really amazed at the whole streaming world and what that means and how that has really transformed our society, our culture, and it will continue, right, with the 5G, the embarkation of 5G, right? I mean, that is going to be amazing.
Yeah. So 5G is going to be really interesting because it's going to help us uncouple from a traditional internet connection. And you and I are older. We both watch television on a TV primarily.
Yep.
I've gotten to the point that when I'm traveling, I often watch television on my phone. In this case, my hotel room has a fairly crummy television. It also doesn't have all the apps I want to use. So I've gotten used to, and on the new iPhone, you know, sitting in your hotel room, that's a pretty good screen to watch on. My son is just used to doing it that way. So I'm not sure when he goes to college, when he moves into his own apartment, and hopefully that's a few years away, I'm not sure he's going to bring a television with him, and 5G will enable him to access really lightning fast video on his phone. I was doing it over, you know, fairly crummy Wi-Fi last night, and it worked just fine.
Yeah, Dan, I know you want to talk about the Amazon and Sears, and I want to get to that, but just real quick, any thoughts about, you know, we all have these personal devices, the blue light, and whether or not that's going to have, you know, affect our eyesight? Any studies that you've seen on that, like, you know, whether or not having the personal device and how close you hold it to your eyes, what the impact could be?
So I think there's always concerns about this. There's hearing concerns about having the phones and the ear pods and all the other things. And I think the reality is just be sensible. You remember when we were kids, they talked about radiation from the television?
Yeah.
That might not be a thing. I don't think either one of us is hulked out, so probably radiation's not a big thing. But what I would say with anything is in moderation.
Yeah.
You know, look, if you're on a plane and you have all your work done and you're going to watch movies for 4 hours on your phone, well, that's not normally what you do. On the average night, I mean, last night I maybe watched 25 minutes, about half an episode of Batwoman before I went to bed, and I'll finish it tonight. So yeah, I think it's probably an issue, especially for younger kids using maybe older models of phones with that have, you know, my son on an off day might have his phone in front of his face for 6 or 7 hours. I try to stop that, but sometimes I'm working and it's not possible. So I think as a parent, as a reasonable person, you want to sort of, you know, think about what you're doing and maybe get outside a little and throw a ball around.
Yeah, I think a lot of us are vitamin D deficient, so that's certainly very important. People need to get out a little bit more, but make sure you put sunscreen on. So Dan, let's transition. I know you had sent me a story about Amazon pulling potential products that claim to cure the coronavirus. What can you tell us here?
Yeah, so one of the big things Amazon fights is its marketplace is so big that you can see scam products. So that might be something that's, you know, a supplement that may or may not work, and it might even be one that's, you know, semi-common in stores, or it might literally be a product that says it's going to protect you from coronavirus when there's absolutely no science behind that. So Amazon is really cracking down on that. It doesn't mean you won't find them. It happens quickly enough that if you pick something illicit that Amazon doesn't sell, there is a reasonable chance you will find it on Amazon. If you order it, your order might get canceled, it might not. This is something I get all sorts of emails on about counterfeit brands and sort of scam products. In this case, it's really just opportunistic companies taking things that may or may not do anything and saying, you know, and sort of playing to the fears over coronavirus.
But what are the I was going to say fiduciary, but I mean, what are the litigative aspects of this, and what are the legal concerns? I mean, is Amazon? I know they're doing their best to pull it down, but it's like, are they on the hook if their marketplace is having products that don't work? I mean, there's got to be some
So,
things
so
there.
this is a very extreme example.
Yeah,
So I'm not sure what happens if you buy, coronavirus be gone on Amazon, and then I don't know, fly to China and get coronavirus. Like
yeah.
that seems like a terrible idea, even if there was something that protected you from coronavirus. But and then you get sick and die. That's a very extreme example. I imagine Amazon would get sued. Whether they would actually have liability there, probably technically in their language they don't. In reality, coming from a family that's in the ladder and scaffolding business that has dealt with liability my whole life, actually being liable and being sued are two very, very different things. So Amazon is making a good faith effort to get rid of this. That said, I've bought things on Amazon that say they deal with pains and aches I'm having or other issues, and those things don't always deliver. But I don't think I'm going to sue Amazon because I bought a $12 thing of pills that are supposed to help your legs not cramp when you work out that don't really do much.
Yeah, I mean, and quite frankly, I mean, you could go into a Walgreens or a Target or a Walmart and buy something that doesn't work, and to that end, yeah, they bought it to distribute it, but I mean, does it? They can't guarantee that the product's going to work.
Yeah, and
So the same
let's
liability
go
probably
back to
applies.
something we talk about all the time on this show. Buy things buy from companies you heard of. If it's a Bayer product, if it's under the Tylenol label, if it's a supplement brand that you've heard of, there's a reasonable chance it's at least going to do no harm. Though, of course, check with your doctor because of interactions. But if you go on and it's like a handmade label and it doesn't, you don't know what it is, be very skeptical and read the reviews and be aware that fake companies or companies selling you counterfeit goods will put up a lot of very tricky fake reviews. And they'll even have people create an account, buy the product, so it says it's a verified purchase. So what you really want to do is focus on the lower reviews, the 1 and 2 star reviews, and read them and understand that every product's going to have a certain amount of that. It's the example I always give is my favorite restaurant in Connecticut. Our first experience there was terrible, and we didn't go back for months, but it didn't prove to be the norm. So if you see a few bad reviews, kind of take them with a grain of salt. But if you see, say, 10% bad reviews and there's hundreds of reviews, that might not be a good product. And if you've never heard of the brand and don't know what it is, be very, very skeptical.
Yeah, I mean, you should buy what you know, right? Buy what you know. That's the lesson here. So Dan, let's shift gears. I know several months ago we talked about Sears and Sears going bankrupt. I know you wanted to talk about them a little bit. Is there an update there?
Yeah, so the joke I always make is Sears' former CEO Eddie Lampert, who by all doesn't have the title but runs the company, is that he is a master at issuing press releases full of bad news that he spins well. For 3 or 4 years now, he's been talking about the turnaround of Sears. And if by turnaround he means it's going to turn 360 degrees and keep going in the wrong direction, that's what's been happening. And so the company, which is down to 182 Sears-branded stores, just took a $100 million loan from a hedge fund that has loaned money to lots of failing companies. And the problem is, if you borrow money just to pay your vendors in a business that's already failing, that doesn't leave you any cash to make any changes. So there's no reason to believe Sears will turn around no matter what the company is saying. At least when you look at a rival like JCPenney, which has similar cash flow problems and a similar limited amount of assets, at least they're trying some new things that if those new things work in small doses, they might be able to go out and get capital to implement them everywhere else. Sears is not trying new things. Sears is basically telling you it's done different stuff, and all it's done is get smaller and have less merchandise.
And then try to borrow money. But what would be in it for the hedge funds or the private equity or whoever they're sourcing capital from? I mean, what's in it if Sears is going, what is this, the dissolution of the assets eventually?
So it used to be very obvious why Eddie Lampert's hedge fund was loaning money to Sears. And this isn't from Eddie's fund. What happened in the old cases is their loans were backed by real estate or other hard assets of the company. In this case, I don't think Sears has much in the way of assets left. So I'm not sure if this 100 million is secured by the potential liquidation of the company,
Mm.
but I'm almost 100% sure that there has to be some sort of guarantee or backing for it. Otherwise, this is like loaning money to a sinking ship in the middle of the ocean.
Yeah, like Titanic, right? You get a hole and you're trying to push water out, and you're just putting it right back on top of yourselves. Dan, what's the lesson here? I want to bring it back to just a macro lesson. The lesson here for retail. I mean, is retail, as we know, brick and mortar, is that dead, or is it just bad business practice on the part of
Yeah.
Sears and others?
So this, it's funny. We've talked about this. This is
Yep.
a pet peeve of mine that every time something bad happens at Sears, the lead in the article will be due to Amazon and changing consumer habits. And the reality is this is due to Sears's bad management. Sears did not shift into an omni-channel model, meaning you can browse at home and pick it up in the store or look at it in the store and have it delivered to your house. They didn't change their merchandise with the times. They basically were fat and lazy and thought they would succeed forever. And even when things got bad, they launched very confusing Shop Your Way. I still get emails from Shop Your Way. I have no idea what it is or how the rewards work. And this is bad management. So Sears is not that different a business from Target. Target is thriving. Walmart, Best Buy, there's lots of retail chains that are doing well. And those are chains that saw the writing on the wall and made massive investments. If you look at Best Buy, they not only changed how they sell things, but they also invested in medical technology and service businesses and things that consumers are going to want. They put huge money into supply chain. I have no idea what happens if you order from Sears online, but it's not something I'm going to attempt.
Well, Dan, what I love about you is you never hold back. And I think that's what the audience likes about you. You tell us what you think, and we appreciate that. Dan, always a pleasure talking with you, and looking forward to having you back on the network on Tuesday. So have a great weekend. We'll talk to you soon.
Thanks, Jeff. We'll talk to you soon.
Bye. Welcome back. Now we're going to shift gears, talk a little bit about markets. Lots going on there. And joining me on the line, he is the co-founder of Delphi Digital, a cryptocurrency research firm, Mr. Kevin Kelly. Hi, Kev. How are you?
Doing great, Jeff. How are you doing?
I'm doing well. Been a short week, but even though it's a short week, we just compressed 5, 6, 7 days into the 4 days. So real busy. But I wanted to touch base with you because lots going on in the markets this week. Why don't you give us your sense of what's going on, and then we can go from there.
Yeah, I think I actually put out a little bit of a tweet thread earlier this week because I'm feeling like we're actually getting to a real inflection point within markets, not just in stocks and bonds, but look across foreign exchange, currencies, commodities. It's a really interesting dynamic right now, and basically what you're seeing is you had gold breakout earlier this week to a 7-year high, right? Actually, within the last 24 to 48 hours, and a lot of that's been based on the speculation around coronavirus and the already kind of slowing economic backdrop that a lot of people have been talking about. And so, obviously, the coronavirus outbreak certainly hasn't helped. And with gold breaking out, you've also seen strength in the dollar and you've seen strength in U.S. assets so far year to date. And so what it basically tells me is that, people want to be in these markets and they want to have exposure to risk assets. Because again, we've talked about, the below average expectations for a lot of different asset classes, especially when you look at bonds, right? And U.S. 10-year treasuries yielding sub 2%. Now they're right around 1.5%, which clearly isn't a whole lot of income if you're looking to really survive off that long term if you're a retiree. So I think you're seeing a lot of people who are wanting to be in the markets because you always have this backdrop of, the Fed and Powell and co. potentially coming in and adding, economics or monetary stimulus to boost the economy, boost asset prices and boost markets. But at the same time, it seems like investors are pretty apprehensive and are still pretty cautious when it comes to, where they're trying to get that exposure. And what I mean by that is if you look at the S&P 500, for example, and you just break down the various sectors and you look at how the sectors have performed this year, surprisingly, the S&P is being led by technology shares, which makes sense because it's kind of the high growth play, but it's also being led by sectors like utilities and even real estate, which the former is much more so kind of a bond proxy or a yield or income play that oftentimes is seen as more defensive. So you've kind of got investors with this barbell strategy of trying to get some type of income, especially with negative rates and things of that nature, abroad. But at the same time, they're not looking to take a ton of excess risk, just because again, there's a lot of headwinds I think that the economy and markets are facing right now. So it's a really interesting point where you're kind of seeing different signals from the stock market and the bond market. The bond market right now, the 10-year Treasury, for example, is sitting at very, very key kind of longer-term support levels. And what that basically means is that, if bonds break higher, if prices break higher, and gold continues to rally, I think that's going to put some pressure on stocks, because it seems like the U.S. equity market is really kind of pricing in more of kind of a V-shaped recovery from the coronavirus fallout, and basically is expecting that, this is just going to be something that's transitory and it's going to shift the demand curve a few quarters, but really won't be too material long term. Whereas some of these other asset classes are certainly showing much more fear among investors. So it's right now the argument is, which market do you believe? Do you believe the fixed income market and the bond market? Do you believe the stock market?
Are you asking me, or is that just rhetorical? Because
that's rhetorical, because
okay, but if
I struggle to answer that myself.
Yeah, I mean, what I would say is, I think you just got to ride. If I'm just the layperson out there and I'm looking at all this volatility, I mean, you just got to ride this thing out. If you're looking to make different sector bets and different asset class bets, I think you're going to get yourself into a woe of trouble, a big amount of trouble. But going back to some of this data, Kevin, I mean, existing home sales decline less than expected in January. You mentioned the U.S. Treasury. You mentioned the coronavirus. People thought that was contained. Now it doesn't seem to be contained. We doubt the numbers out of China. What about emerging markets and the impact there? I know China just I think they had to lower their interest rate. Now they're containing people within the country. I mean, it is very much a police state in general. Now it's even ramping up its police state efforts in order to contain the virus. I mean, what do we make about this in terms of the impact to emerging markets?
Yeah, it's a great question, and certainly if you're looking again long-term horizon, diversified portfolio. I mean, I've always been in the camp of having some emerging market exposure, just because again, if things, it's interesting if the best case scenario, not just for markets but just kind of globally, if you think about the global economy, if let's say the coronavirus does end up getting more contained than people think, and it really is just kind of a shifting of the demand curve out a few quarters, and it's much more transitory, and you start to see economic growth return to developing markets, that actually would be kind of the best case scenario for emerging market equities, because then in that scenario, when you have better growth prospects, potentially yields and rates rising, you would expect the dollar to weaken a bit, right? And the dollar's actually had some considerable strength recently, which is kind of throwing more fuel on this global economic slowdown concerns, because a stronger dollar is not good for the global economy historically. And so if you had a situation where growth really picked up in the developing markets because all this was transitory, that's actually kind of the best case scenario for EM, because you would expect money to potentially flow out of U.S. assets, which has been kind of the most popular markets to be in really this entire cycle, for seeking out kind of greater growth prospects if the outlook becomes a bit brighter. Right now, it's just very tough because you're seeing EM take it on the chin a bit, at least the last couple of weeks, because of the strengthening dollar and a lot of these concerns over China being a big part of the emerging market picture, especially in the equity market indices, and really just kind of fueling the developing market growth that's happening, especially in the Asia Pacific area. Just all that uncertainty, I think has people flocking back to U.S. assets, has Japanese investors, for example, kind of repatriating some of their capital back home, because again, it's just too much uncertainty right now at this juncture for a lot of people to stomach.
Yeah, so let's shift gears. I want to talk cryptocurrency now, because in the past, I think the last week or so, Bitcoin really was, it's been pretty volatile. I think we'd all agree that the crypto asset digital currency asset class has been pretty volatile for a lot of reasons that we've talked about. But I think when you were last on, Bitcoin had a really good run up. What about this market volatility? And I think there was a correlation when there was actually, I wouldn't say flight to safety, because that's not a good set of words to use, but investors were flocking to Bitcoin as a way of as a safe haven, right?
Yeah, no, it's kind of interesting too. If you look at your traditional safe haven assets and you look at this latest rally, right? Really back, let's say, December of 2019, so over the last 3 months or so, you had kind of the gold and then the bond market and then utilities in the equity markets kind of all rally and break out a bit. And then you saw kind of Bitcoin almost lagging, which is really interesting because some people like to look at Bitcoin as kind of a leading indicator of what might to come. But that being said, I think again this longer term dynamic of expectations, and it depends on where you are as a market participant on the future outlook for the fallout from not only coronavirus but all of the potential damaging supply chain effects and things of that nature. If the outlook beyond 6 to 12 months is actually a lot better than people think or realize, then actually I don't think that's going to be very good for Bitcoin and kind of these safe haven assets like gold and treasuries, at least in the near term. And Bitcoin certainly has had a great run up, but I mean a lot of crypto assets that underperform Bitcoin, in fact, over the last 12 months, 18 months, have actually increased by even more this year. Have had some pretty sizable price run up. So it's not just a kind of Bitcoin phenomenon going on right now in the crypto market. So it's a little tough to say where we go from here. 10,000 was certainly a very psychological level.
20,000.
We saw
20,000,
yeah,
Kevin. That's where we go.
20,000 would be great. 20,000 would be great. And I think, long term, sometime we'll get there, but I don't necessarily know if it's going to be tomorrow, just because, again, there's a lot of uncertainty you would think would drive people into Bitcoin, but you just haven't quite seen that in mass yet, right? So I think it depends on if you can actually get some of these, kind of larger global macro players, and then eventually some more conservative funds to allocate even a small position, kind of as the ultimate hedge against things going really, really awry. But again, I think people are just going right now with what they know, right? And Bitcoin's still being battle tested, hasn't technically gone through, really significant economic downturn yet. And so I think people are flocking to your more traditional safe havens like, bonds and gold, because that is something that they trust more.
Well, Kevin, a lot of pension funds, endowments, foundations, they're investing in hedge funds, these alternative investments. And I just want to make a kind of a correlation. And, I'm not an equity strategist like yourself. Hedge funds have not done well as a matter of practical matter over a long period of time. I mean, they have had significant outflows. And does that actually lend itself to crypto? Does it help cryptocurrency in that regard? Because if hedge funds are underperforming, these big asset pools are looking for alternative asset classes. Cryptocurrency, for the most part, though volatile, has had a pretty good run. We talked about 10,000. Who knows where it goes? Is there an opportunity? And we know that private equity has $1.5 trillion or more. Or I think that's the number of powder that's dry powder that's on the sidelines. Does that create an opportunity here for some of these asset pools in asset classes like cryptocurrency and digital assets?
Yeah, I mean, it certainly does. I mean, I think more so from the uncorrelated nature of Bitcoin and other, crypto and digital assets versus some of the more conventional asset classes that we've talked about. I mean, hedge funds, it's a really interesting discussion, quick, because I think hedge funds actually get a much badder or worse rap. I don't even know if batter is a word, but a worse rap than
It is now.
It is now, right? Get a worse rep than they deserve, though, because if you think about, just the basics of what a hedge fund is intended to do, I mean, it has hedge in its name. And so you wouldn't necessarily expect, I mean, it's very kind of barbelled, right? You do have some outperformers who are just, your top hedge funds that have had incredible runs, and there's, the smartest, you consider them, really the smartest of the smart money. But by and large, the average hedge fund, it's almost kind of a bit of a zero-sum game. And when you have, a cycle in which the S&P and just a basic passive investing strategy has performed so incredibly well, both in the equity side of things, but also in the bond side of things, the fixed income side, it makes it a very difficult environment for, individual stock pickers or hedge fund, equity long short portfolio managers to actually outperform in that environment, right? So I think actually, if anything, now is kind of the time to be, re-looking or re-examining potential hedge funds to get into on the active side of things, because again, if you start to see some of that passive money get a bit scared, get a bit worried, start to flock to things like gold or bonds or even cash, putting more cash on the sideline, I think, some active hedge funds out there will certainly be able to scoop up some pretty good assets on cheaper valuations or cheaper prices than they would be able to. I mean, that when that downturn happens, if it's 6 months from now, 3 months from now, 2 years from now, is anybody's guess. But I do think that active management is not going anywhere anytime soon. It's just been a very difficult environment or backdrop for them to outperform.
Yeah, well, it certainly is interesting time for a lot of reasons, Kevin. We've got, even though we've had some volatility this week, the Dow Jones Industrial Average over 29,000, S&P 500 doing predominantly very well over the last couple of years, and we've gotten some really good economic data. So, these little, we're going to have, we've talked about it before, we're going to have volatility, we're going to have these little ups and downs in the marketplace. I think people just need to, if you're listening out there, just need to kind of ride things out.
Yeah, no, absolutely. It's definitely not the time to do anything too drastic. But I am, as a big fan of understanding what you own, and it's always a good time to kind of just reevaluate or understand, what your exposure is to the stock market, why your portfolio fluctuates the way it does. Not saying track it every day, but I think just having a good kind of understanding of, how well you've potentially done over the last 10 years or so, and kind of maybe even moderating some of those expectations because. As we've said, the next 10 years, the outlook at least isn't quite as bright as the last 10.
Yeah, well, Kevin Kelly, always a pleasure talking with you. And actually, I think you just trailed Donald Trump as the tweeter, the head tweeter. As the tweet master, I don't know what you call it, the head Twitter master.
I'll take any of them.
Absolutely. Well, great talking with you. Have a great weekend, and we will talk with you very soon.
Thank you, sir.
Bye.
Talk soon.
Welcome back. We're going to talk a little retirement now, and joining me on the line from her Market Watch office, Miss Alessandra Melito. She is the retirement reporter for the previous noted Market Watch. Hi, Ali. How are you?
I'm good. How are you?
I do feel well. I'm having this moment where I feel like we've talked before, but talked recently. But it's really great to talk with you. Happy Friday, because we record this on a Friday, even though we release it on a Sunday. What's top of mind for you and your teammates over at MarketWatch this week?
Yeah, so I watched the debate on Wednesday, which was quite exciting, much more exciting than previous debates.
Okay.
And so politics have really been on my mind, for better or worse. So one thing that came out of this particular debate was that Mike Bloomberg, the former New York City mayor and a billionaire who's running for president, he was on the debate stage for the first time. And he had actually also released a retirement proposal earlier this week. It was Sunday, I think he did. So I wrote a few stories about that. The first one was just about how what he would do as far as retirement security. He's, some of the candidates have touched on various aspects of retirement security, such as like Social Security and, long-term care and all that. But he had drafted this document with various proposals, and I was able to dive into that a little bit. He had, pretty common plans for if he were elected president as far as what he would do. And, of course, it touched on Social Security. It touched on Medicare. He said that he would also, he would want to encourage people to save more for their futures and have auto-enrollment, which is, of course, a very popular way to get people to start saving for retirement. So that was that. And then I also did a separate story on his mention of the fiduciary rule. So far he is the second Democratic candidate to mention it outright. Elizabeth Warren was the first one. So I talked to some people about what they think is the likelihood of the fiduciary rule coming back. So just a little background, the fiduciary rule was Obama-era legislation that required broker-dealers to act in their clients' best interest. So if there were two, investment recommendations, for example, they would have to recommend the one that was the best for the client, and that means like the lowest fees, as opposed to maybe choosing the one right behind that best one that was suitable for the client, but maybe came with better commissions for the advisor. So that role was killed under the Trump administration within a year and a half or 2 years of him coming into office. And Bloomberg and Warren have said that they would bring it back. A lot of people that I spoke to, advisors and other financial planning experts, they said that the Democrats, that's a very strong position that they hold, that, you know, the fiduciary rule was something that they were proud of and that they wanted. And, you know, they would, if a Democrat comes into office, there's a very strong chance that some sort of a fiduciary rule will come back. But, of course, there are lots of challenges associated with that. To make sure that the legislation is long-lasting, it goes beyond one administration. You know, if like a Republican were to come back after the Democrat, and so on and so forth. And yeah, so the fiduciary rule and candidates, that's what I've been thinking about lately.
So, and then we do have the Securities and Exchange Commission kind of taking an independent look. This has nothing to do with the debate, but they have been possibly thinking about doing something around this fiduciary rule as well. And is it your sense that in addition to potentially the Department of Labor under a new administration launching the fiduciary rule as a possible outcome? Is that what you're hearing?
Yeah, so SEC came out with Regulation Best Interest, which so the SEC oversees registered investment advisors. But they came up with this rule that was more than just retirement accounts. So going back to the DOL rule, that was for all advisors, and it was for retirement accounts. The SEC oversees registered investment advisors, and FINRA, the Financial Industry Regulatory Authority, oversees broker-dealers. And that's the one that has like the suitability rule where you have to give your client a good recommendation, but you know it could also come with a higher commission than maybe another product. So the SEC came out with Reg BI, and Reg BI says that for all accounts, you have to act in your client's best interest. But a lot of critics say that it's a weaker version of the DOL fiduciary rule, and that it won't really do that much as far as like, you know, providing security and lower cost advice for clients. So if a Democrat were to come back into office, there is a strong chance that they would maybe dismantle Reg BI and try to create a rule that looks that would align the Department of Labor and the SEC. Because right now, well, in the past we had the DOL. The DOL rule died. Then the SEC came out with its rule. The SEC was actually also looking at a rule when the DOL rule was in place, and because the DOL rule was it took like a decade to come out. And now we also have states that are saying, oh, we'll come up with our own fiduciary rule. Like, could you imagine having 50 states saying, this is how you have to provide investment advice in my particular state? Like, that could be chaotic. So if a Democrat were to come into office, he or she would probably try to streamline the process so that advisors didn't have like 800 papers to, or forms to go through in order to provide advice for their clients.
But let's be clear. I mean, you probably wrote and heard about the story with Delaware, right? That's a perfect example where there was a broker with Horace Mann who wound up telling people not to enroll in the 403B plan, but to enroll in an IRA. So these teachers, like 100 teachers, and then that person and that firm was sanctioned. Clearly, there are bad actors, and those bad actors need to be penalized. And so, there's something that you can't. I don't think you can rely on the industry to police itself. So some level of additional regulation is needed, right? I mean, it just, from my perspective, hearing the Delaware story and actually having the opportunity to talk to the treasurer, there's some bad actors out there. It doesn't mean that everyone's a bad actor. So we need regulation. We need the ability to curtail that type of behavior and punish those when they, do bad and harm people. At the same time, I agree with you 100% that if you have 50 different rules, you're going to drive brokers and advisors and people out of the business. So that doesn't make any sense whatsoever. So there's got to be a balancing act. And I think that the industry needs to partner with the government to police, to get this taken care of, because we just, something needs to be done. I mean, people should not be put in expensive products simply because it benefits the broker or the advisor. I mean, that is just, it seems like an upside down mentality, because the consumer is completely not aware, Allie, of what the costs are, what they should be, and they're trusting these people. They're reaching across, going into an office and saying, "Help me," and then they're getting shoved down their throat, oftentimes expensive products. They don't understand the fees, the lockups, all the other things that go into that. So clearly, something needs to be done here, whether it's whether it's a Democrat or a Republican or an independent or nobody.
Yeah, absolutely. And in the meantime, because a lot of people say that the Reg BI isn't strong enough law to help clients, clients or potential clients should be very vigilant in how they get their financial advice. So there are various tools that they can use aside from just Googling the financial advisor. FINRA has Broker Check, which if you were to go to FINRA's website and you go out to Broker Check, you can search for the firm or the financial professional, and you'll be able to see if there are if anything stands out, any red flags, or maybe the advisor had been penalized for some sort of action that he or she had taken in the past. So you'll be able to see that on his or her record. And then also SEC has the IAPD disclosure database, and you can also search for financial advisor on that. That would be a registered investment advisor, not a broker-dealer, but you can see their background as well, and if there were, if anything stands out. So those are two really important databases to check before working with a financial advisor, and also, asking questions like, how do you get paid, or how do you get paid for the advice that you give me, which indicates if you are a fiduciary or not. RIAs are, under the SEC, are required to act in a fiduciary responsibility. Certified financial planners, which is a very specific designation for, as you can imagine, financial planners, they are held to a fiduciary responsibility as well. And those are just a few things that you should do.
And you should know the difference, Allie. I mean, you just use a couple different terms, and you should know the difference between a salesperson, someone who works for an IRA, someone who's an investment advisor, right? I mean, those are...
Yeah, but sometimes you don't.
Yeah.
Financial advisor is such a broad term,
It is, but...
so sometimes you don't know who you're dealing with.
But you should ask those questions, right? I mean, if you're vetting a financial planner, someone who's going to work, you're going to work with, and trust with your money, right? You're not going to put it under your mattress. You're not going to put it in the bank and earn less than 1%. You're going to trust this person. You need to interview these people. I mean, I don't care if they're your brother's friend and you think they're part of the family. You still need to get and understand who they are, what they do, what their fees are. Interview them like you would when you go see a doctor or when you go buy a vehicle. You have to get under the hood and know who your service provider is.
Absolutely, and you should tell them. If somebody told me that a prospective client shouldn't feel afraid to ask, like, are you working in my best interest, or having that advisor put it in writing if they're not a CFP or an RIA, having them say, specifically outline how they are acting in the client's best interest and their investment strategy, how they get paid, how often they contact the client, or like during what circumstances they should expect communication. Those are just, and also how they choose their investment products when they are making recommendations.
Yeah.
Those are all important questions to ask.
Absolutely. Well, she is the amazing, that's your new nickname, the amazing Alessandra Melito. And Allie, we're going to talk to you later on in the week on the television network. I know you've got some really cool tips and some ideas around Social Security that you're going to bring up. So great talking with you. Enjoy the rest of your weekend, and we will talk with you next week very soon.
Yeah, talk to you soon.
Bye.
Bye.
Welcome back. We're going to wrap things up with a discussion about retirement policy, legislation, regulation, and who better to do that than our friends, the Legal Eagles. And joining me on the line, one half of those Legal Eagles, David Levine. He's a principal with the Groom Law Group. They're an employee benefits law firm based in Washington, D.C. Woo! And he's back on the East Coast after being on the West Coast. So, David, how are you doing?
I am doing wonderfully. Happy Friday afternoon recording, Jeff. It's good to be here.
It's good to have you, and I know you are back from the West Coast. A lot going on in your world, and we're actually going to have you on later next week on the network as well. But let's just dive right in. What's top of mind for the Eagles, the folks at Groom Law? I know there's a lot, but what are you guys talking about?
Well, guess what's back? It's back again. State plans. Tell a friend. And that's where we're going to begin. Harkening back to the Backstreet Boys, how often do you tie benefits and Backstreet Boys together? Not that often.
No.
But I thought
you
this
did
week, we've been hitting it pretty hard and doing it our way by talking about Secure. But at the same time, what we decided is, we'll take a little bit of a break. We didn't get any major guidance to point to this week. But talking about something else. This week we had a very lively, interesting debate with a bunch of Democratic contenders. I know a couple of weeks ago, Kevin and I talked about their platforms, and we did like a speed review. But we thought maybe this week, and I guess it's just now instead of we, it's now me because my fellow Eagle is somewhere up in the clouds. What we thought we would do is actually talk a little bit about the state plans this week. Although I feel like Mr. Walsh has actually just joined this call.
I think he did. Hi, Kevin. How are you?
Hey, everybody. It's great to be on. I'm here from Las Vegas, Nevada, where I'm hoping we're going to talk a little about my bet this week is we'll talk about state plans, David.
Yeah, that was good, Kevin. I'm glad we got to coordinate beforehand. So what we were going to talk about a little is, Kevin, without even knowing it, is going to talk about the public option plan from Michael Bloomberg and the others that are out there. But we thought we'd sort of do a little bit of table setting. You have the state secure choice IRA programs, which are basically, if you don't offer a plan, you have to automatically enroll your people, subject to certain exclusions, in a state-run IRA program. You deposit through payroll. Pros, less work for the employer. Cons, well, you don't get much customization, you don't get that much control, and the contributions aren't that large, but it's a good way to get people in the system.
Well, and David, what I've heard about those plans is one of the issues is that if employers participate in kind of these state-run programs, that they've almost lose the ability to view their plan as its own retention tool. So there's been kind of a sense among employers that there might be some cost savings in some ways, but on the other hand, the ability to customize and retain is reduced. What do you think about that?
I think that's actually a really good point, Kevin. And I think it ties to one of our other favorite topics that I promised we weren't going to touch this week, like MEPs, to MEP or not to MEP. That is the question. And at the same time, I think you're right. These IRA programs work really well for folks who don't want to do that much, who don't think that having something unique in their retirement benefit program is essential to them, but also it does provide for increased coverage, which is a wonderful thing. So I kind of describe it as a starter. It gets people into the system. And if you look at it that way, then the question is, where do we go from there? And Kevin, you want to talk about the public option?
I think there's a sense growing that it would be more beneficial, that there's a sense growing among some kind of running for president at the moment that if the government ran kind of a retirement program that private employers had access to, that we could also see a large increase in coverage. Now, it's still pretty early in the primary season, and the different proposals are going to be pretty varied as time goes by. But I think it just highlights one of the things that you're talking about at the state level, which is that, the solutions we're seeing at the state level, particularly in some of these blue states, could become prevalent at the federal level if there's a Democrat elected this fall.
Yep, and I think that's a big deal, Kevin, because these public plans, in the later days of the Obama administration, they proposed to allow, even though private sector couldn't do it, to allow public sector to do so-called open multiple employer plans for public employers. And these public plan options would kind of feel like that. And there's different views about competition in the marketplace. You can get into a lot of politics. We'll stay away from that for today.
So David, would you call these public employer pooled employer plans?
Public employer PEPs. Yes. We're coming next week on the Weekly Pulse, a glossary of terms that nobody outside our industry understands. But yes, it could be. but to actually get something serious rather than humor, although that's more interesting, is there's the whole question of, do you want governmental entities? Do you want a vibrant marketplace of competition with both in there? Or do you want no governmental entities? There's a lot of different views, and I think it very much depends on where you sit and your political background. But certainly, I think we're going to see, to use the big word of the day, a cacophony of different options out there, whether it's the state IRAs, it's the marketplace solutions where you have many choices, where you have MEPs, PEPEPs, you could have single plans. There's so much out there, but we'll have to see which way we go. But and of course, don't forget, we have this small thing called an election in December, which is
in December.
Oh, November! Wow, vote late, vote never. Yes, vote in December. So that clearly it's Friday afternoon. So we are clearly making our point this week.
Hey, Kevin, I want to give you the opportunity. It wouldn't be a show without having us talk about missing participants. What's going on with that and some data collection?
Actually, hold on a second here, Jeff. I've got to ask Kevin. Kevin, can you tell me how public plans will impact the missing participant problem?
So I think one of the problems that we'll see for these public employer, pooled employer plan systems is that they'll have participants who, even after enhanced searches, will be missing. So these PEPs will have PES issues. Their ability, it'll be interesting to see how the government goes about searching for participants. We know that talking with folks at PBGC, just to be a little more serious, that PBGC provides benefits to individuals where the company providing benefits has kind of run out of money. And talking with their former leadership, they struggle to find participants just as much as private sector employers do. So I think this move towards or this sense that maybe the government solutions might provide an opportunity to solve kind of all aspects of plan administration. I think it'll take some time for that to shake out, and that many of the issues we see will remain, but they'll be the government's problem if we go down that path.
Which means it's going to be our problem, right? I mean, at the end, not yours and mine and David. We're just part of the citizenry, but it'll be all of our issues.
Exactly.
Man, so very, very interesting, and the. Just last comment and get your feedback, for 30 seconds is the 401k retirement industry is an evolved ecosystem, right, David and Kevin? I mean, there's a lot of different twists and turns, and it's not a perfect world. It didn't develop perfectly, and so is it really conceivable to think that we can just create the perfect system just with a wave of the wand, right? I mean, these things take time to develop, meander. You've got all these other issues that come up, like missing participants, people that are not part of the system, and it's just an ever-evolving, iterative process, it seems like to me, from the outside looking in.
Exactly. You're absolutely right. I agree. And that's a wonderful way to wrap us up for the week, isn't it?
Absolutely. Well, guys, I want to thank you. And Kevin, thank you. Like we always say in show business, better late than never. Appreciate you coming on. And, we thought we would have to put an APB for you as like a missing participant, but you actually came. So thanks.
Well, it's okay, Jeff. Don't forget, I can track him on his Instagram ad, so we can find him anytime.
Oh, my Lord. All right, guys. Well, always appreciate your contribution. And don't forget to check out David Levine later this coming week on the BRN AM network. So we'll talk to you guys soon. Have a great weekend.
You too. Thanks, Jeff.
Bye, guys.
Thank you.
Well, that wraps up this episode of the BRN Sunday podcast. I want to thank you, the audience, for joining us. And, of course, I want to thank our contributors, members of the media, academia, and financial services for the time they make to come on the program. So until next week, I'm Jeff Snyder. Keep on saving, and don't forget, roll with the changes.